Hey everyone, welcome to another KER Market Quick Take. I'm Corey Fleck,
And I am Shad Marquitz.
and we are your hosts for another quick take focused on the precious metals sector. Shad and I are going to be discussing valuations, exploration plays, mergers and acquisitions, and maybe a little portfolio strategy at the end. Just to bring everybody up to speed on really this historic run in precious metals as gold is now over $4,000 and continues to move higher. Gold just this year has been up 7 of the first 9 months of the year. And since the end of September, it's been 7 weeks in a row with gold up almost 20% just in those last 7 weeks. That was right after that summer sideways consolidation. GDX this year has outperformed gold. It's been up 8 out of the last 9 months. The only one down month was less than a percent correction. And year to date, it's up almost 130% just in the last 9 weeks, where GDX has been up every week in a row, up almost 50%. GDXJ, similar moves to GDX with a slight outperformance, especially recently. The juniors, not even the ones in GDXJ, I've noticed is really outperforming. Silver is also joining into this party, as we all know, but especially in the last 4 months, with silver up almost 50%. Shad, one thing we hear a lot about some of our guests, and what I think is very important for investors in this space when they're looking at the equities, is valuations. We always hear that stocks are cheap. I usually throw those comments out because I really think valuations need to be analyzed. Yes, a lot of the easy money has been made, but if we're in a longer term bull market, you can still find stocks that are generally undervalued compared to, I guess, peers or the broad market, but also some of the stocks that maybe have gotten a little too overheated and money should rotate out of them. So, Shad, how are you looking at valuations? What metrics are you using right now?
Hey, Corey. Well, I mean, there's a lot of different things people can dive into. You can use all those traditional fundamental things like price to enterprise, price to book. You can look at forward sales of their producers and extrapolate out what kind of a multiple should that have. When you're getting into the development stage companies, there are the economic studies that the companies put out that give you a net present value, but you got to kind of take those with a grain of salt because they're using a 5% discount rate. So I think it's more helpful to use an 8% or even a 10% discount rate on an MPV of an economic study. So whether that's a PEA, a PFS, or an FS. And so you can look at what's the market cap of this company relative to a multiplier of that. And you can also look at it through the lens of the metals assumption used, but I still look at things in current spot prices too, just to get a sense of what is this project worth today at the current gold or silver price. And a lot of time that's a lot different number. In fact, right now they're eye-popping numbers. So I think that there's a lot of ways you can look at that. And I also look at peer comparisons. I look at similar sized deposits. What is 2 million ounces getting in Canada or in the US or in Australia in this company? Why is it so different with this company? And that makes me dive under the hood to go, what is handicapping this one company versus the other? Or has one gotten more inflated? So I love doing peer comparisons based on market cap and based on somewhat similar kind of projects. And with exploration companies, it's really hard to value them if they don't have resources out. If they have a resource, you can do something. But if they don't have if they're pre-resourced and they're a drill play, the beauty's in the eye of the beholder. You can start stringing together some drill holes and try to figure out what you think it could be and leapfrog or something. But I don't know that anybody has a good way of valuing exploration companies at the bottom end or at the high end of the risk curve because they don't really have anything to quantify yet.
Yeah, I completely agree on the exploration front. Without a resource, without any sort of fundamental data on, especially an early stage discovery, hard to really value those things. Those turn strictly into momentum plays, I think. But you're right. What I use is compare these companies to peers and to the market. And I don't like to compare them to peers that are much larger or much smaller and try to extrapolate the difference there. If you have a 2 million ounce resource, I like to compare it to companies that have, yeah, say 1.5 to 2.5 or 3 million ounce resources and see what those ounces are getting valued at. You will find some pretty big disconnects in this market, some being much more overvalued and some still trading for, we're still seeing $20 an ounce in the ground, some even $30 an ounce in the ground in decent jurisdictions. And then producers, look at what they're producing. Look at their cash flows. Use those cash flows to really balance out their market cap. Those are easy formulas to run, and you get to see where some, quite frankly, are trading at a discount. And to the economic studies, I honestly don't even care what price they do these economic studies at. I just want to see sensitivity analysis so I can put them all at whatever price I want to use and see what the IRR is. That's very important to me. And look at the CapEx too, because CapEx, higher CapEx is obviously shy people away and they're just harder to fund. But these are some of the valuations that we look at. And again, it's all comparison. And right now, you have so many companies to compare out there, especially companies with resources and now economic studies. When you're looking at those economic studies, we should also say just note what year it's done. If it's done in the last year and a half to 2 years, the CapEx numbers are a bit more solid. You can build in a little bit of inflation, but if it was done 4+ years ago, that really needs to be updated because so much has changed on that. One other aspect about valuation, Shad, curious to get your thoughts on that. Jurisdiction. Yes, there are tier one jurisdictions the whole way down to some very sketchy areas and some new areas that are coming out of the woodwork. How much weight do you put in jurisdiction before they're a producing company?
I of course look at it and I'll handicap a jurisdiction like West Africa more than I'll handicap something like Europe, but I'll give a premium to US and to Canadian assets because they usually trade at a premium and that's just how the market acts. Australia is kind of straight down the fairway, but I would say one other wrinkle that you have to look at when you're looking at valuations of companies is the sum of the parts. And I don't see enough analysts doing this. I don't see enough retail investors doing this. Let's just say you're looking at a company that has three projects. One's in production, one's in development, one's in advanced exploration stage. You got to look at those three things and discount down the exploration stage one maybe, but the development project may be the bigger project. It may be worth more on an NPV basis than the producing asset is, and yet the producers will often only get judged through the lens of their revenues and their balance sheet and what they put out on their quarterlies, and I think that's a mistake. Sometimes the best value that a company has is their bigger development project. And so that's another thing you want to look at when you're looking at producers. And then with developers, another thing on those economic studies is yes, look at the capex, but also look at the sustaining capital. I see a new gimmick going on in the industry. I don't want to call it a gimmick, but it is a massaging of the numbers where
Oh,
people are coming
financial
up
engineering right there. Yes.
where they're saying, "Hey, look at this low capex," and then you look at the sustaining capital, and it's as much as the capex every year after that. It's like, well, whoa, whoa, where this thing's not going to throw off enough money for that. How are you going to pay the sustaining capital? So, what do you think about something like that when you see it, Corey?
Yeah, it's a great comment too. Look at all the costs that go in there because yeah, some of these guys are pushing off some of the sustaining capital. Sometimes it makes sense. Sometimes you can start with a much simpler operation, generate some cash flows and then build out some of that infrastructure later on. That's totally fine, but yes, put those numbers together and just see if the company can fund it at least in the first couple of years and then through production. And yeah, the growth aspect, always weigh that out because in this market, growth is excellent. We want to see production growth in the near term. The sooner, the better. Within the next year, within the next 2 years. Once you get 2 years out, we don't know where the metals price is going to be. And I highly discount a lot of those growth expectations when you're 2 years out. Again, because we don't know what the price is. In terms of valuations, we haven't talked too much about this, but well, we have privately. I think you know my thought on this, but the whole theory of look at how much other companies have spent on this project. They've spent $100 million. They've spent $200 million. If it's pre-production and that's all drilling costs or costs of really poking holes in there, building up resources, I I pretty much ignore those costs. To be honest with you, I think those are sunk costs, and I don't think we should give much value to those. I think you should be focusing more on what the asset is at its current level. But we are hearing a lot of companies now saying, oh, we're bringing this asset into our books, and past companies have drilled this many meters and they spent $200 million. We're getting it for $20 million. Look at the deal we're getting. To me, I put zero value in that, to be honest with you. I judge the asset where it is here and now. Shad, what about you? We hear this all the time when new companies or when companies bring on new projects and they really promote just how much other people have spent on them.
Yeah, I'm kind of in the middle of the road on this one. I don't think that it's worth zero because the companies before them have spent a lot, but I think it's a very nuanced take, and you need to look at it a couple different things. If it's drilling that you've done, do you have access to that core? Can you relog that core? And more importantly, was it drilled recently enough that you can actually count it in an economic report? Like if you do a resource report on and file it, NI 43-101, can you use all that drilling? Because if so, there is value there. If it's all historic and you've got to go re-drill it all anyways, then it's less important to me and I don't put very much value on it. Where I do think sunk value or sunk cost have value is if a company is picking up infrastructure that already exists. If you already have a mine that's built and you've got a tailings dam already constructed, or you've got a shaft already built that you just need to refurbish, or you've got a mill that you could actually use, big distinction between one that's just there for marketing, a mill that you could actually use and refurbish, then those sunk costs have value. And if you can get those on a fire sale, it's like getting anything used at a good deal. I do value those kind of sunk costs more than just drilling.
Yeah, I find those hard to value though, because so many times we have heard this is built, and then a year or two later we hear, it doesn't really work for what we're going for. So that's where actually site visits can come in handy, or just listening to other people that have been on that site, or mine engineers, which can tell you if it's actually worthwhile or not. All of these play into valuations, but again, I think the most important thing being compare companies to peers and break it down into some very simple factors to see if you see glaring disconnects. Let's also talk exploration. We've seen a lot more interest in exploration stocks, rightfully so. These companies have money, they're drilling. The problem I have right now with true exploration is I feel like in this gold price environment, too many other assets work at these prices. So a tier one discovery, no matter what market you're in, is going to get attention. But tier two discoveries, tier three discoveries, even if you're out there right now drilling a hole that hits 100-gram meters, so you take the grams per ton times it by the meterage. That used to be a standout hole. Nowadays, it seems like those holes are coming every week and they're not getting the same pop that they would in a market where investors are a whole lot more discerning. So a lower gold price environment, I know it sounds crazy, but if you can make a discovery in a lower gold price environment, I think you can get a lot more attention than in this environment. That being said, you hit a 400 gram meter hole, your stock is going to fly. But that also comes down to what are you drilling? Right now, if I'm in an exploration stock, I want to see companies drill a whole bunch of targets, because it's rarely the first target that is the company maker. And if you put some wildcat holes in there and you hit something, that can change the whole story. I'm thinking of Snowline. Their first discovery, while being a good one, wasn't the Valley discovery. And then the Valley discovery has turned out to be a total game changer. Even Prospector Metals, who we had on the show recently, they were drilling with the current program a couple other areas much more heavily, and they put two holes in this new area, this test zone. And that was the discovery that made the stock jump 3 to 4x in a day. So for me, if I'm investing in exploration, I want to see companies spread out their targeting to hope to find that really game changing hole. Chad, I know you're not big into the exploration plays, but how are you viewing them in this gold price environment?
Yeah, and I should say that while I'm not as heavily weighted to exploration plays, I still follow hundreds of them. We talk to hundreds of them, and I follow along to see what their projects are doing. I like to get in post discovery, really, once there's economics on it, but I'm following all the early stage all the way up through it. And what I see is a lot of noise in a market like this. So I agree with the point you made, Cory, that when you're in a bear market and nothing's working, the few discoveries that are made that are legit actually become a buy the news event, where most drill programs in a bear market became a sell the news event. In a bull market, everything seems to be getting bought. Every company's raising money. Everybody's excited about everything. It makes it very difficult to discern what's a good drill hit. I think you made another good point that 300 grams per ton hits are the new 100 gram per ton hits. So per meter hits. So what used to be 100 grams per meter was a great hole I think you actually have to do more now. I think you people have gotten desensitized to that. I think you have to hit like two, three, 400 gram per meter hole, and then you get on people's radar. But the other thing with the expiration stocks, and I was just writing about this on my Substack channel just this week, they don't have the longevity that something like a royalty company or a producer or even some of the more well-known advanced explorers or developers that have ounces in the ground. Most explorers are not going to run for years. They're going to run for a target or for a drill season. And then when they get retested, a lot of these things fall apart. As we know, it's like 1 in 3,000 targets become an economic mine, which means the vast majority of these things are not going to hold up over time. So I think that you got to go back to the old statement, these things are lit matches. While they're running, while people are excited about this target, while there's Momo in the stock, I think they should be trades where I think you can actually hold on to a royalty company or a producer or a developer for a longer period of time. And if it's a great exploration stock, it'll become one of those. So that's my thoughts on explorers.
Oh, well, we can tie this into M&A too, because so many people, when they get into really any company, especially the small ones in this sector, they're looking for a takeover. And we have seen a lot of M&A activity in the mining sector. It seems to still be fairly big deals, at least the whole acquisition front, the merger front, the M in the M&A. That's been happening in the lower end, but that doesn't move the needle for shareholders. It is the acquisition front that can provide that pop and that liquidity for the longer term investor. I have some data here from M&A globally, not in mining, but just global deals. First half of 2025, overall deal values rose by 15%. It's a huge number. The value is $1.1 trillion just by mid-year of this year. That is globally, driven a lot by the Americas, especially the US. But overall deal volume declined by 9%. So it's not just mining where we're seeing these mega deals, it's across the board. Tech, healthcare, energy. It is all big deals that are driving this. So in the smaller stocks right now, as much as we're waiting for that M&A to creep down the board, I think we can look across the sectors and see if that's starting to happen anywhere. Because right now, it's not the small companies getting acquired. It is the larger companies. Look at the Tech Anglo American deal recently. Another mega deal, but that money's not filtering down to the juniors. Right now, yes, I realize we're waiting for the mid tiers to make some of these acquisitions, tie up some of these smaller guys, but I still think these mid tiers need to build up more cash to have the comfort to make these acquisitions. So, as much as M&A, I think it's been very hot in this sector. Hasn't come down to the juniors yet. I don't know if it will, at least for the rest of this year, even into next year. Who knows? Shad, you view M&A. We're talking about M&A all the time, but again, it's big deals that are happening.
Yeah, I concur. There's a lot of the big deals, whether you're looking at big tech or big oil companies merging or big healthcare companies merging. So no different in the mining sector. We've seen a lot of those mega mergers, and we have seen some of the mid tiers being aggressive and picking up development projects or single asset mines. We have seen some of that the last couple of years, but I'll be honest, I expected to see a lot more. At these higher metals prices, there was a delta between the mid tiers and the juniors, like the developers and the explorers, where they could have exploited that more because there was a big spread. Now the juniors are playing catch up, and so they're less likely to use their paper, and they're going to have to, as you say, build up cash and do a cash deal. I think investors like cash deals better, but there was a window of opportunity there for about a year where the mid tiers had already run a lot and the juniors hadn't, and that was the window. I think we should have seen more aggressive deal flow, but there are some of the mid tiers teaming up to become bigger companies, like we just saw with Caliber and Equinox forming a larger, a major out of that, and I think we'll see more of that. But I also think there's a misnomer, Corey, that we should talk about, and that's that every single company believes that they're the next takeover, and there's 1,000 exploration stocks. There's probably several hundred development stage ones if you get into resources and economic studies, and they all claim they're the next takeover candidate. There are not enough producers. Even if we add all of the majors, there's only about a dozen majors, and maybe the 3 dozen mid tiers together. You're talking about 40 to 50 companies. There's no way they can buy hundreds of projects or thousands of companies. So the reality is many will be summoned, few will be chosen, and you're hoping that you're in the ones that get taken over. But I think a lot of people have a pipe dream. They think I'm in these until a takeover, and the reality is most of the projects in their portfolio, most of the stocks they hold, are not going to get taken over. What do you think about I guess, the illusion that everybody has that they're the next takeover?
We've heard it forever. Everybody wants to be a takeover, and I understand. Why not? It'd be great to be a takeover candidate. It's great to get taken over. There are just too many deals that we've seen, even when companies have been taken over, where management wins, but the shareholders don't really see those kind of gains, especially when you see some of the change of control that management have in these deals. And yeah, you're right. You need to look at who the buyers are, and it's just not a very big pool of companies right now. And quite frankly, I still believe that a lot of these majors have a pipeline of projects, and that's why whenever we see these mergers of these majors, they start shedding projects, not using their bigger companies to go out and buy these little companies. I understand the impetus to be bought, but quite frankly, you do need to look at if the team can build it. And we are starting to see a lot of these juniors build out teams that can build these mines. Just look at G Mining Ventures. That company really came out of nowhere with people saying these guys know how to build mines, and they have built a mine, now building two. And boy, oh boy, is that share price done really well. I think that needs to be the new focus. But that also ties into portfolio strategy, right? Do you have an exit strategy that is not simply a takeover? Look, we've been talking a fair bit about trimming right now or building cash, and it's being treated as a four-letter word right now in the sector. People are saying that you're crazy to trim. You're crazy to sell anything that's moving higher, even if it's spiked higher, gone through a euphoric phase. Quite honestly, I like having just a little bit of cash on the sidelines. And when we do see these historic runs, remember what I said on the onset here, GDX up 9 weeks in a row, 50% higher. You are seeing some huge gains in your stocks right now. It's not a bad idea to trim some of these positions, or even if you're up 3, 4x in a position, trim 20% of it. Take your money off the table and ride that stock for free. You're still going to have the exposure to the upside, but at least you have the protection to the downside. And again, back to the valuations, you can use that now free money that you have just made to spread out your bets and hopefully find another stock like that. I know we'll probably get ripped on for this, but when you are up so much in some stocks, and if you're analyzing your portfolio and one stock is 20%, 40% of your portfolio right now, I realize it's a huge winner, but you can still be a winner while you take just a little bit of money off the table.
Yeah, man, I completely agree. And I see comments in other people's video feeds, even on our own video feed sometimes, about people saying, why would you guys want to sell anything when gold's going to 7,000, 10,000? It is completely irresponsible as somebody that's allocating capital not to take some off the table when you're up triple digits in stocks or in an ETF. And like you say about GDX, it's even worse with GDXJ. It's up 144% for the year. SILJ is up 148% for the year. And if those ETFs are up that much, you can just pull up a lot of charts and see that there's certain stocks up 200%, 300% just this year. That's not including gains investors may be sitting on. Last year was a pretty good year in 2024. Some of these things are up 200 to 500% over the last year to two. And if you're not pulling gains off the table when you see those kind of triple digit returns, then you're not really being responsible. And people said, oh, well, you just don't have the confidence it's going to keep going. You can have the confidence this market's going to keep going by keeping 80% of the position in, like you were saying, Cory, or 70% of the position. You don't have to be all in all the time in one stock or a couple of stocks. And if a stock starts becoming a larger and larger part of my portfolio, I am just not comfortable with that kind of exposure because you're increasing your risk exponentially. And so you can have some limits on how big you want a size of a position in your portfolio to get, whatever your own personal preference is. But if it's at 20, 30, 40% of your portfolio, you're way overexposed to that. You're going to be more emotional about that stock or that ETF or that sector, and you're probably not going to think clearly. So I do think that you can have not hard and fast rules, but some systematic ways that you take profits or that you tranche in and tranche out of a position. You don't have to buy it all at once, and you also don't have to sell it all at once. So you can start trimming a little off the table. I've been taking off 5 to 10% positions, especially in ones that are dual listed companies where there's no fees to trade them and where I've held them for more than a year, so there's not the higher tax ramifications. You can trim off small positions without it really affecting you in a big tax way and without it affecting you in a premiums that you're paying your trading account way. But you're taking some of that money and building up a little war chest to go deploy it either when you see deals in the sector or into other sectors and rotate that money into other commodities or other things that are beat up. So I've been taking a little bit off the table in gold and silver and placing it in oil stocks that are beat up, or I put some in uranium stocks when they dip down in April, and that's worked out pretty well. So I think that there's options that you have when you're not married to a stock and not holding for 10,000 gold and 200 silver. Even if we get there, you don't want to hold 100% all the way up to that because there's going to be gut-wrenching pullbacks and you want to manage accordingly.
Yeah, look, I've been through this before when I first got into the sector and I saw some of these stocks go way up and I held because you keep hearing just how great it's going to keep being, just how it's going to keep going higher. And then you just watch it start dropping, 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 and gets really hard to sell. The best thing to do, again, is just take a little bit off. And if you do start to see it drop, at least you know that you've taken your money off the table. You have locked in some gains. You're not going to ride it the whole way up and the whole way back down. Not saying that these things are just going straight down after this, but there's so many opportunities out there still in this sector, and celebrate the wins, but also make sure that you do actually take some wins rather than, again, just this thinking it's only going to get better until it doesn't, and then just being mad at everybody because it didn't get better and you got stuck in a position. We'll wrap it up here. Always interesting here, Shad. I love doing these quick takes with you, and we're talking all kinds of different topics for the active investor in the resource space. Please, everyone listening, send us your thoughts. Send us any topics, broad topics that you want us to discuss, and we'll be sure to include those in future KER Market Quick Takes. Everyone, thanks for joining us this week.